Hello, everyone. This is Stock Market Daily. Thank you for joining me today. It is June 20th, 2023. As always, this is not financial advice. Please don't copy the trading strategies you see here because you will lose money. This is only for educational purposes. Okay, so looking at the S&P 500 today, we did get a little bit of a gap down after a 3-day weekend. This was almost a little bit of expected because we did have a really strong last week. In fact, I believe it was 7 days in a row, which was a record since 2020 or something like that, where we had 7 days in a row that were green. So on Friday, we did sell off, and it looks like we did continue today. Not much news over the weekend, nothing bad, no good news, no bad news really. There was some China economic data that was released over the weekend, and it wasn't great. But I think in reality, the reason why we had this gap down and sold off a little bit here, it was because of the crazy run up that we had all through last week. So, um, looking, the first thing that I was doing, I was looking at my flex grid, where I have Apple, Microsoft, Amazon, Nvidia, Google, and the advanced decline line for the S&P 500. And it did look like everybody, all these stocks except maybe Nvidia, were kind of following the same trend. We had the gap up, the gap down was trying to close. Some stocks did end up going green, not the overall market though, but some stocks did end up going green and then sold off kind of in the same manner, except, like I said, NVIDIA, it was a little bit of a sell off, but not as much, and it just continued to go up ever so slightly throughout the day, just a nice little melt up. The real winner for today was Tesla, and Tesla was up all day. So take a look at their chart. So that is today right here. Just continued melting up all day. And I do believe that that kind of propped up and supported the S&P 500 here, especially in this area right here. So if you overlay the two, you'll see that Tesla started running up really nicely at this time frame as well. So enough about that. We all have our own interpretations of what the market is doing. So let's take a look at the trades. And if you're following along, you'll know that I'm trapped on quite a bit of the call positions. So I had quite a few here today, and I did something usually what I do not do in the morning. I usually wait till the end of the day. However, I noticed that one thing, and that is the um, the actual, last week I was able to roll today's position, the 0DT position, into next day, and I was able to collect between $70 to $90 depending on the strike, but overall pretty much all of them, even my worst one which was like 42.15 or so, I was able to roll into next day for about $60. Today there was no premium left, and that was just not going to happen. And unfortunately, some of these positions on the call side, I had to roll into next week. And some of them were rolled into next week as far as the 28th. So, but I did roll them into the 28th, plus I moved up a strike price. Not two strike prices or three, just one. So the premium is really low on these positions that are deep in the money here. And some of them, I don't know if I want to even call it deep in the money, because we were just in this territory a couple of weeks ago. But regardless, the premium was already gone, and most likely it's due to the fact that the FOMC meeting was last week. So there's nothing really for the market to be really scared of. And have any volatility. So the other thing that I do want to mention is, you know, The reason why I did that in the morning is sometimes you might just get lucky. So if you put an order out and the order at that time that you put it, you know that you have to get out of the position. It's going to be expiring today. It's deep in the money. There's might be no reason really to wait for the end of the day, because no matter what happens, unless something really catastrophic happens and there's some kind of crazy news, we're not going to drop, about 150 points from where we are. Or, we're not going to drop like 200 points. So, I mean, it's possible, but it's highly unlikely. So I put the order out, and essentially it eventually got filled, but I put them out in the morning, just because it's a low probability trade. So eventually they got filled, and that kind of saved me a headache at the end of the day, because those are kind of harder orders to get filled, especially when you are deeper in the money. You might have to uh, give it some more time. You might have to move up a day to try capture more premium, so the order fills. And so I do it in the in these cases I do it in the morning. I did place one and only one trade on the put side. I sold premium at the 43.75 level. You could see it here. It was left here. For that one, I did collect only $200. It could have waited a little bit, but it seemed like the market, I just hated to, I didn't want to lose the premium that was already there. It was even so, it was higher. It was like 270 was my first order that I placed. And then I had to chase it down. And I said, all right, whatever, $200, I'll take it. So the market obviously went down after that. We were in the money here. And, that was a welcoming sight for me, because I had all the call options that were still trapped here. However, the market moved up, obviously, and this is expiring worthless. Now, if you are paying attention, or kind of if you're following along, you did notice that from Friday, there was one put position that was trapped from the previous Friday, and I rolled it into today, on Tuesday, into the 43.90 strike price. So that one was perfectly placed, because I ended up buying this one back for $20, and I am now out of it. So all my put positions are out of the money. There's no put positions anywhere here. Only the calls. Now, the worst case scenario for me would be to get trapped also on the put positions, and then I can't sell any calls and I can't sell any puts, and then I'm not making any money whatsoever. So because of that, on Friday, I rolled the position from whatever it was on Friday. I believe it was 44.25 or something, and I rolled it into 43.90, and I collected very little premium for that. I still collected premium, but I collected very little. However, I rolled it to the lowest possible strike price that I could, in order for not to get trapped in this, somewhere over here. The point is, the point of the strategy is to always end in cash, not have anything overnight. Obviously, it's impossible when you have these positions on the call side that got trapped, and this happened while I was on vacation. So I couldn't do anything about this. These were already in the money, and the only thing you could do is roll them and do some other splitting and things like that. But the point of the strategy is to always try and end in cash. So I'm glad that worked itself out the way it did. And that is pretty much, for the SPX, that's the only trade that I did. Was I rolled these into, some were into this week, others were into next week, sold one of these. And for that, I collected $566 when you count the one I had to purchase back, which was the 43.90. So not a lot, but the point is, guys, not every day you're going to make thousands of dollars. The point is to continue doing the strategy. The point is to continue making money on the strategy. The point is to make sure that you're watching your risk tolerance, that you're not selling too many positions, and that your account is able to handle these types of run ups or big drops. So if it comes down to it, my account is able for now. I mean, I could still get in trouble here with the calls if we continue running to like 4,800. But for now, everything is fine, and I'm not worried about it. And it's important to remember that on the SPX, there's no early assignment risk. So as long as your account can handle the spread between where it's in the money and your long side, the side you sold, between this, right, and between something that you bought here, as long as you could support that, and if the market is moving up and going against your position, it's just important to have that spread for you to be able to grow the spread as the market is going against you. So for me, it's going in the upside, and I can potentially buy a higher strike price to support my short position, which is this one. I can buy a higher strike price, still about a 2 or 3 weeks out from the day that is expiring, and the margin that is required needs to be able to support it. So that's really the trick. I mean, if you're trying to do this with the very tight spreads, this is not a good idea. This is not going to work out in the long run. You might run into an issue. And I believe I had a question about it, so I'm kind of answering that question here today. So we'll see what happens tomorrow. It's going to be interesting. I know we do have some Fed speakers coming up this week, so we'll be seeing how the market reacts, and we'll be placing some more trades on the put side. And tomorrow it's going to be only 2 of these that need to be rolled. I'm sure we're not going to sell off as much unless Chairman Powell is very, very hawkish. If you think back, like I believe it was some kind of meeting in Wyoming, I think they were, and that's what causes big sell-off. So if he's very hawkish, we might sell off even more here. But I don't think that that's going to be the case. I don't think there's a reason for him to do that. I think we've already been through a lot, and we already know what has happened with the interest rates, and we have a much clearer picture than it was about a year ago. It was called Jackson Hole. He was in Jackson Hole when and during that interview or after the interview, we had a massive sell-off. So I don't think it's going to be like Jackson Hole, but it might move the market, and that should be tomorrow. So it's going to be an interesting week. So stay tuned. I appreciate you guys watching, and I'll see you in the next one. Thanks. Bye-bye.